Thank you very much. On behalf of the Bundesbank, I would like to welcome all participants. It's great to see you, even though this is just a virtual, not a physical conference. I think we all agree this is the safer way of interacting these days, and it hopefully will be good interactions where we learn a lot from each other. We've had a really great set of submissions, and it was hard to select the papers that were on the program, but they're really nice papers with lots of interesting new material that's also policy relevant, which is something that we care about at the Bundesbank. So we very much look forward to all these presentations and hope for a good interaction despite the virtual setup. And so let me hand over now to Christian. Christian.
Well, thank you, Emanuel. And first of all, thanks to Emanuel and the Bundesbank for co-hosting and sponsoring. I guess you've all felt the virtual dinner yesterday evening. At least I hope so. Too bad that we couldn't have that this year. But anyway, it's great to have all of you with us for this exciting event. As I said to Ralph before, there are many downsides to Corona, but one upside is that, you know, there are people who would probably had a hard time to come over for just a day or two for this event. They're now with us to present their papers or to discuss papers, and I think that's great. I'm looking forward to an exciting and stimulating workshop. Just one remark, and I mentioned this to Roberto and to Zorka, who will first appear on stage in this event. We're going to record this. If this is not fine with you, please let us know. But I think it would be great to have this on file in a sense, because it's a great event, and it shows how the collaboration between Bundesbank and SAFE and the interaction with all of you great international researchers helps to promote the cause of asset pricing, which is of course a very noble cause. So without further ado, I would hand over to Roberto to present the first paper, Real-Time Price Discovery via Verbal Communication, Method and Application of Fedspeak. Roberto, the floor is yours. You have 25 minutes for the presentation. Afterwards, it will be Zorka with a 20-minute discussion, and then 5 minutes for the public. Afterwards, during the break, if you want, you can stay connected and tell the author that the paper is really crappy, but you didn't want to speak up during the session and all those other things. And I'm happy that you're all around. So let's get started. Roberto, your turn.
Thank you very much for including this paper in the program. Can you see my slides before I start?
Yes, at least I can. I hope everybody else can too.
This is joint work with Marco, who is also here at this workshop, at this conference. So central banks today give high priority to communication with financial markets in an attempt to shape market expectations. Indeed, the effect of monetary policy on the economy today not only depend on the current policy actions, but also depend on the agents' expectations about the future path of monetary policy. It's for this reason that it's important to understand how economic agents form expectations and how these expectations are shaped when faced with individual messages coming from the central bank. And this is particularly important given what's the current strand of a growing macroeconomic literature that shows that investors update their expectations too slowly relative to a full information rational expectation framework. So what we're going to do in this paper is we will provide first granular evidence on the agent's expectation formation process. That is, we will identify individual messages coming from the central bank. So here we can even go at the word level. And then we will see market expectations, how they change around these individual messages that we are going to identify. And the main takeaway of this paper is that investors fail to fully incorporate the central bank message. So here we have some sort of underreaction. And we will show you that this failure is economically large. And the way we will do it is we propose a market timing strategy that trades upon this information. So before I describe in detail our empirical contribution, let me very briefly describe what's the methodological contribution, which is in essence, okay, how can we identify these individual messages? And we will take as a laboratory the dates in which the Federal Open Market Committee has a scheduled meeting, and we will focus on the Fed Chairman press conference videos. So what we will do is we will extract the audios from these videos, and we are going to split them into two 2-second audio frames. And the reason why we want to do that is because we will know the exact words said at this specific 3-second audio frames. And then what we will do is we will use an end-to-end deep learning algorithm to convert this audio into interpretable text. And once we have text, we can use standard textual analysis tools with this timestamp text. And then once we have this timestamp text, we will align it with high frequency financial data with exact words spoken at each particular point in time. So overall, we will have the link between the specific message sent by the central bank or by one party and the signal received by market participants by looking at financial data. So this is what we are after. So this is first how our data set looks like. We have the exact starting time, the exact ending time, and the exact words said during this 3-second audio frame. And we think this is a nice contribution to the literature because it broadens the type of questions we can ask, given that we have better identification with respect to the message sent by one particular party. And the financial assets will give us what was the signal received. So now what we're going to do in this paper is we will consider all press conferences, extract one common message out of these press conferences, and then see how market asset prices react around this common message that we are extracting from the press conference. So let me describe you what's our empirical finding, and the way I will do it is let me provide intuition for our main results by explaining you what happened on one specific day, and then we will generalize the results. So what happened on the FOMC meeting of July 31, 2019? So here we have at 2 p.m. the policy statement release. And basically, if you see the statement, they added 2 big changes. The first one is that the committee decided to lower the target range for the Fed funds rate by 25 basis points. And the second one is that they added a new sentence into the statement. So basically, they got rid of the sentence in red and they added the sentence in green. They add basically, as the committee contemplates the future path, it will continue to monitor. So basically, this is the new information that arrived to the market when they released the policy statement. So what we are going to do in the first stage is we will identify these sentences added or removed between consecutive statements, and we will posit that this is the new information coming to the market, and we will search for these sentences into the press conference. So, okay, let's see what happened half an hour later during the press conference made by Powell. So here what we can see is that at the moment, reporters were allowed to ask questions. So in the Q&A section, Powell was assaulted by questions on the meaning of this change. So 5 minutes after, we have, okay, per your statement here, I guess the question is, what did you really mean by this change that you added by this green sentence? And then here he said, okay, we are thinking of it as an essential in the nature of mid-cycle adjustment to policy. And then you can go through all the press conference and you can see this back and forth between reporters asking about clarifications of the statement and Powell trying to reply what they meant with this statement. So what we're going to do in the paper is we are extracting this reference to the statement within the press conference, and we will see market reactions around these sentences. Okay, let me explain you now what happened during this specific day. And for now, I will just focus on the euro-dollar exchange rate, which I plot here. So on the y-axis, we have the time, and on the y-axis, we have the euro-dollar exchange rate. So here you can see if the dollar goes down. So if these plots go down, we have a dollar appreciation. So you can see that at 2 p.m., the dollar appreciated. And the reason for that is that market expected a higher rate cut than the one that they actually did. Then half an hour during this time window between the statement release and the press conference is seemingly quiet. And then the press conference came, and here we highlighted in red reference to the statement. And you can see here 2 things. The first one is that price moved a lot when they mentioned these statement-related changes. So here we have high price volatility. And the second one is that prices move on average in the same direction as they did around the statement release. And once you accumulate all of these price changes, you can see that the price change around the press conference is of the similar sign and similar magnitude as around the statement release. So here, the overall signal received by the message of the central bank was that, okay, there was no future path planned for a series of rate cuts. So what we do in this paper is we generalize this for all press conferences, and we consider a wide range of asset prices. So let me very briefly summarize the results. What we show is that every time the chairman discusses changes between consecutive statements, price volatility and trading volume spike dramatically, and price move on average in the same direction as they did around the statement release. Once you accumulate all of these price changes, we have a strong positive correlation between the price change around the statement release and the subsequent press conference. So to put some numbers now, for instance, the autocorrelation for medium-term euro-dollar future is around 40%, or for the SPY is around 44%. And then finally, we will assess the economic significance of our findings by proposing a trading strategy. So here, the gains of the trading strategy will tell us the magnitude in monetary terms of these patterns in the data that we document. And okay, the final question is, what can explain our findings? And we show that our findings are consistent with investors on the react to the original message sent by the central bank around the statement release. So before I go to the within press conference analysis, let me just briefly describe you what's the relationship between price changes around the press conference relative to the price changes around the statement release. So here it's important to understand, okay, if prices or incorporated information contained in the statement, condition on these prices change around the statement should not predict price movements around the press conference. Yet we find that these press conference price changes are quite predictable. So before we show you these results, let me first show you how we think about these results by providing the conceptual framework of this paper. And basically, we are basing our conceptual framework on this paper by Moench and Rice. And the idea is that if we assume that agents' expectations are updated according to the following process. So here, ft of xt plus h is the agent's expectations. So basically, these are the agent's expectations, ft of xt plus h. And they are a weighted average of two different expectations. The first one are the stale expectations of the agent with condition on ft minus h. And these are the rational expectations, et xt plus h. So the stale expectations have some weight lambda, and the rational expectations have the weight 1 minus lambda. So in essence, lambda measures the extent of expectation stickiness, how much these expectations are anchored to the previous expectations, the ones that do not include the full information. So if lambda is 0, the agent's expectations are equal to the perfectly rational expectations. If lambda is between 0 and 1, we have some sort of underreaction. So once we assume this process for the agent's expectations, we have that the revisions in expectations are autocorrelated. What means is that changes in expectations between ft minus 1 and ft minus 2 predict what will be the changes in expectations between ft and ft minus 1. And basically, in this part of the paper, we will run these regressions and try to get this parameter lambda. And the way we will do it is we will regress price changes around the press conference, which go from usually from 230 to 330, with the price changes around the statement release, which is standard in the literature, that goes from 150 to 220. And so here the idea is that the information that makes these prices move around these two time windows is dominated by the information or by the message sent by the central bank. And here again, if expectations are perfectly rational and we don't have market frictions, prices should include all of the information at 230 before the press conference. So lambda in essence should be, if anything, equal to 0. So before I show you the regression, let me just show you how these shocks look like. And so here I'm plotting the scatter plot. On the x-axis, we have price changes around the statement. On the y-axis, we have price changes around the press conference, and these are basis points. And I'm showing you here for the Fed fund futures for 3 months, 6 months, and 12 months to maturity. And here what you can see is that we have a positive relationship between these two price changes. And these relationships become stronger if we move to more on the maturity spectrum. To see this here, for instance, I'm plotting the same for the euro futures, where we can go to further the maturity. So here we have 12, 24, and 48 months. Now, once we have these data patterns, what we want to do is test the statistical significance. And the way we will do it is by running this pooled OLS regression, where here we group asset I into bucket K and run this pooled OLS regression, where we are considering different asset classes. For instance, we are considering Fed fund futures, where we divide them between short and medium term that goes from 1 month to 6 months, 9 months to 15 months. So basically this express the market views about the short-term monetary policy. For the medium term, we look at euro-dollar futures that goes from 6 months to 12 months. For the long term, we have from 24 to 70 months. So here we are using quotes. And then we also consider stocks and Forex. We are considering 8 major currencies. So here the parameter of interest is lambda. And basically you can see that this lambda is quite significant. And then something quite surprising is that this lambda is very similar across these different asset classes. So consistent with this model, it would imply that if we have different traders trading these different asset classes, they would have a similar degree of expectation stickiness. And the third thing is that the R-square are pretty high. For instance, for stocks, we have an R-square of 10%, Forex 30%, and these are quite high given that these are intraday predictability regressions. And we are not focusing, for instance, you start to see these levels of R-squares if you look at annual type of regressions. So once we see these patterns, what we want to see is, okay, are they strong and stable enough that we can make a trading strategy profitable? And so here, this trading strategy will quantify in monetary terms the value of this information rigidity that we are documenting. So here, the simple trading strategy that we can come up with that doesn't require any parameter estimation at all is the following. So at the start of the press conference, you just look at what happened during the statement release. If prices went up, you go long. If prices went down, you short, or you can even stay out. And then just look at the over performance of your strategy relative to the buy and hold strategy, which is basically you just buy and hold it throughout. So here, for instance, one way to go this profitability is by just running this regression, where on the left-hand side, we have the market timing return. And on the right-hand side, we have the buy and hold return. And so here we care about the constant, which basically gives you the average return after adjusting for the buy and hold risk exposure. So here you can see 1 basis point for medium or long-term euro-dollar futures, 12 basis points for stocks or Forex. In the paper, we provide many statistics, but for now, given the time constraint, we only will going to show you, for instance, the cumulative performance within the press conference. So here, x-axis is minutes into the press conference. So 0 is the exact starting time and 50 is when the press conference ends. And we are plotting for euro-dollar 60 months, SPY, and euro-dollar exchange rate. So what you can see is that this across asset classes, we have an outperformance relative to the buy and hold strategy. And to put this in monetary terms, so we know that each basis point move in the euro future contract, which is actually what we have here, it's equivalent to $25 per contract. And the nice things about future is that you just have to put a margin of around 200 and you will get after 50 minutes, $25. And then the second thing that is very interesting is that the overperformance approximately starts in minute 10, which is exactly where the Q&A section starts. So now with Marco, we were interesting to see, okay, what is making agents to react in the same reaction as they did around the statement release? And for that, we need our new machinery because that gives us high identification of what words were said around these specific minutes. So let me go to that, discuss this. And before that, let me just very briefly discuss the conceptual framework again. So here the idea is that if the Fed wanted to communicate a message, it will do it first at the statement release. And then what we are going to do is we are going to extract those news that the Fed wanted to communicate at the statement release within the press conference. So these minutes where they discuss the statement, we call it statement related minutes, DT. And here without loss of originality, you are assuming that these are the only moments in which investors update their beliefs about the original message sent by the Fed. If we have that, we can write these expectations of the investors as a weighted average of the investors' priors and the new consensus view, where the weights will depend on this parameter stickiness and the number of times where they talk about the statement-related minutes. So once we have that, we have 3 testable implications that in the paper we take to the data, which is, okay, every time they talk about the statement-related minutes, we have that a fraction of investors update their beliefs and they will trade accordingly. So they will express their views by trading in asset markets. Then we see that forecast revisions will move more. They will go from X underbar, which is the investors prior, to X upper bar. So we have higher price volatility. And the second is that forecast revisions will move in the same direction as they did around the statement release. So basically they go from X underbar to X upper bar. So now let's bring that to the data. So for that, we need first to construct this variable dt, which I haven't shown you how we do it. So basically what we did is we aggregate these 3-second audio frames or text into 1-minute frequency. Then we run a standard part of speech analysis of the statement news to obtain the noun, adjectives, or verbs of these words added or changed between 2 consecutive statements. And then we will just search for these words within the press conference, and we also consider their synonyms. And finally, we want to be super conservative, and we added an extra requirement that these minutes should mention the word statement. So dt will equal 1 if 1, 2, and 3, and 4 are satisfied, or 0 otherwise. And then we also manually check that every time we put a 1 there, that minute was actually a question or an answer about the statement-related minutes. So let me summarize you the results. So in statement-related minutes, price volatility increased significantly. To put some numbers for medium-term UR futures, stocks, and Forex, we have that price variation is about 40% larger than the other minutes within the press conference. So these are times when they talk about the press conference that are moving prices a lot relative to the rest of the press conference. We see also that trading volume increased significantly. For your futures, long term is 70% larger, or for Fed fund futures above 9 months. So we have 50% larger trading volume. And if you look at these days, these are the days where we have most of the trading in these securities. And then finally, we have that price move on average in the same direction as they did, and the initial reactions around the statement release. So basically, we want to run this regression, but I don't have time to show you the results. In essence, it's like we run the price level change in minute t for asset I, and we just divided the regression into days in which we have a negative shock around the statement release and a positive shock around the statement release, and then we just look at the loading coefficient. So here the model predicts that B minus is negative and B positive is positive. So here we have the results, and here the first thing is, according to our model, we have that these loadings are negative significantly, and the order of magnitude like 4 times higher than the constant. And the same for positive shocks. And once you accumulate these average price changes, you can see that this explains around 60% of the overall price change around the statement release. So here, these are the instances where we are seeing that price move in the same direction as they did around the statement release. So I think that's everything we wanted to show you today. So let me first conclude. So here, I think we provide a nice way to analyze public available data via these press conferences. And the reason why we like press conferences is because you can extract, the exact moment in which they are mentioning each specific word, and that will give you a higher identification of the message sent by one party. We applied this method to the chairman's words, and we find that investors' expectations gradually incorporate the Fed message sent at the statement release. And then the nice thing working with financial data is that you can propose a trading strategy and then quantify in monetary terms the value of these data patterns that we are documenting in this paper. And maybe I was 1 minute earlier.
Well, thank you very much, Roberto. Actually, you were almost 2.5 minutes early, so this is something
perfect.
that one has to get used to on these occasions. But thank you very much for keeping the time, or for sticking to the time so strictly. And the discussant is now Zorka from SAFE.
Okay, so let me just set up my screen sharing, just a second. Now you can see. Okay, fantastic. So I don't know what happened in the meantime. So let me thank the organizers for including me in the program. So I have some, I can provide you with some instructions regarding technical difficulties. In any case, so I thoroughly enjoyed reading the paper. I'm very glad that I, got the task of discussing this paper. There's a bit of a disclaimer I have to make in the beginning. My background is predominantly finance and financial economics, and you will see I come from that type of literature. So many of my comments will point in that direction, but hopefully, I can still say something that's going to be useful and could improve the paper on the long run. So of course, Roberto did a very good job summarizing what the paper is about, but in my reading, the paper studies investors' expectation formation in reaction to monetary policy news. I think one of the greatest novelties is that they don't look at the FOMC announcements, but actually post-FOMC announcement press conferences. And really the most beautiful thing about this is that so before the announcement is made, there is a preliminary statement that's being released. I don't recall that this has been mentioned, right? So there's a preliminary statement, then there's the announcement where the actual statement is being released. And then after that, sometime after that, there is this session where the chairman is explaining what has changed. So to some extent, we can say that there is a very exact time moment when we can capture where any policy uncertainty is being resolved from the investor's point of view. And I think this is really great about the paper. So of course you guys also have the methodological contribution, which is very nice, that you convert the conference audio or the video to a timestamp text that you can, later match with high frequency financial data. I think this database really has a lot of potential. You can potentially dig, even deeper and further to really pin down the mechanisms there. And as a result, what you find is that investor expectations underreact to central bank messages, but you also find that there's large asset price changes, increase in trading volume and price volatility, especially at the time when the chairman discussing policy changes in the first part of the press conference. And I'll be talking quite a bit about these findings. So when I looked at this paper, I'm not very familiar with the specific strand of the macroeconomic literature, but what came to my mind immediately is that there's this fairly large literature on the effect of central bank announcements on the stock market. And so, if you look into how the FOMC meeting, FOMC cycle is affecting stock markets and, some other markets that have been already documented in the literature, Emanuel has a paper on it, Schlag, Morse, Wissing-Jurgensen, and so they have a series of papers on it. It would be very nice to look into these because some of the findings that you document to be puzzling are actually empirical facts documented in these papers and could help you to explain your findings. And when I looked at the paper, to be honest, it ring the bell to me that this is very much about market efficiency as well. So market efficiency in reaction to macroeconomic news announcement. So one of my first suggestions would be that maybe you can improve the link to these various trends of the literature, especially the one on the stock market effect of the FOMC announcements and cycle. You have this result on the trading strategy where you're contemplating that, this trading strategy is partly predictable, as well as you see that there's this stronger result for long-term assets. And I think this could partially be explained by the Fed put documented in these papers. The Fed put is practically this fact when the Fed observes that the stock markets are underperforming and not doing very well, they actually tend to provide this unexpectedly accommodating monetary policy. So if this is something that keeps happening and the financial press talks about this, so this is something which is, pretty well understood by financial market participants, then investors can learn about this and they can price this expectation of this, potentially accommodating monetary policy into the prices. And I think this could be one of the reasons why you find stronger results for longer term assets. The other thing that I kind of had in mind is that when you look at the sticky expectations right around the press conference, that these are just very short-lived. It can, it really looks like a very basic textbook case of not fully informationally efficient markets, just incorporating news as the new information arrives and investors learn this and they can actually, incorporate it in prices. So my further comments are going to be about the research framework and the identification strategy that you use. And I see that this monkey and rice framework is appealingly simple. And I'm not suggesting you should do anything else, but what you have to keep in mind is that actually this dynamic price adjustment model that you look at comes with a couple of implicit assumptions that are not necessarily at par with how financial markets in reality work and what you would be observing in the data. So the main points that I have here is the first implicit assumption that you have is that markets are fully informationally efficient, as I would teach, strong form market efficiency holds. Agents update their beliefs and they acquire immediately full information. So we have to look into this, whether this is something we can expect to be able to observe on the market. Then you also require markets to be frictionless. And I'll explain why I don't think this is the case. And actually your results reflect that this is not the case. And I think one of the most important caveats on the framework is that it actually assumes that investors only trade when they learn something, when there is information that's driving the trades. And if I look into the next slide, I can show you that, practically if I look at your results, some of these assumptions are challenged, in financial markets. And when I look at the statement, which is really like, the flagship result of the paper is that the investor expectations underreact to monetary policy news. The first thing that comes to mind, it might not be that it's actual underreaction. It could be that this is really just very hard to proxy expectations by price changes because this price is not only reflecting information. It could be that, we just observe a not fully informationally efficient market and that there's frictions that are present in the markets. So elaborating on the very first point, what I want to emphasize is, so it might be hard to proxy expectations for the reason that there are actually actors, economic actors present on these markets that don't trade based on information. And what comes to mind immediately is high frequency traders. More specifically, imagine a contrarian type of high frequency trading algorithm, right? When people try to incorporate the information and there's this algorithm kind of going against them, trying to profit from this type of changes. And I actually also started, looking a little bit into the microstructure literature. And first of all, I have found a paper which shows that HFTs are quite active around macro news announcements. So, here's the reference. You can look it up. This might be helpful to motivate if you implement any changes related to this. On the other hand, there is this part when you talk about what kind of changes happen during the press conference. And, telltale signs of HFTs being present in the market is that trading volume goes up, price volatility increases. These are all things you document. And on top of that, there is low liquidity. And the reason why I think there is low liquidity is if you look at this strong positive autocorrelation that arises in the prices, in a sense of, Roll 1984, that's kind of showing that liquidity is decreasing in the markets. So that's kind of why I think that we have to keep in mind when we are observing these prices and price changes, maybe there are all these actors on the market that might be introducing noise. And I think one way to handle this, and I will talk a bit more about this later, is to potentially, shorten the window that you're looking at. Okay, then next, I think it's very clear that markets are not fully informationally efficient. Unfortunately, we cannot rely on that. There's market frictions, and just the very result you're documenting that the chairman delivers new information to the market and it gets incorporated actually pretty fast already shows that I think this is the case. And the trading friction I had in mind is exactly this liquidity issue that I just explained relative to positively autocorrelated prices. Then I think two things that could be very easily fixed is, first of all, the window length in the estimation. And second, I think how you're processing the cross-section of the observations that you have, the pooled regressions. I think that these 30-minute windows around the announcement and press, like around the announcement window and an even longer one in the press conference could potentially be too large, especially because if you think about it, the most valuable contribution of the paper is, I believe, is the data set that you have constructed. And it actually gives you the ability, as Roberto also emphasized, to be able to capture the very moment where, where news arrives to the market. So I think we should be using only these moments and a very, very narrow, potentially just a few minute windows around those moments, prior and after, to be able to really capture when this actual information updating is happening. And I think this could potentially decrease the noise from HFTs. But, regarding my HFT comment, you might want to talk to a microstructure person or look into the literature. I don't know, whether these HFT noise components average out or whether they would be pushing the results into one or the other direction. So that is something that perhaps you want to look into. Then I also find you're considering 41 of these press conferences. And what you do empirically is that you just pool all these 41 press conferences over time together. And, there is actually a bit of research internally from the Fed system documenting that the Fed has been changing its communication strategy and the level of transparency it's providing to the market over time. And so this paper of Rosa, for instance, finds that market reactions become more and more muted as Fed is becoming more transparent. And with the pooled regression, you really cannot capture any time series aspect of this type of change, in communication that, of course, the rational market participants would be learning and incorporating in their expectation formation. So one very quick fix to potentially account for this is to, I remember you mentioned that I think starting from 2019, every single announcement has a press conference. So that's a higher level of transparency. Maybe you could, somehow just have a dummy variable, something in the regressions to capture that. And I personally think that maybe adapting an event study type of structure could be more useful to be able to pin down the effects. Whether you're looking at price changes, whether you're actually looking at this difference between price changes, capturing the update in the expectations. Then I think possible extensions you could do is to expand really the scope of the paper by considering how the finance literature measures announcements effect around the FOMC events. So as I said, I think it's important to look into these papers that I if you want, I can give you the references, because the Fed put could be something very useful for you to consider, or there's also an alternative story that information leakages from the committee or members related to the committee can also, practically dilute your results, so to say. If you look at short windows, this should not be a problem. If you look at longer windows, maybe somebody's tweeting something that might not be helpful. These are things to also consider. And I think the paper would really benefit from just very narrowly focusing on this best feature of the data that you're aware of the exact moment when the news arrives, and just do an event study and with a very, very narrow window. And in this case, you would not have a lot of confounding issues or potentially this noise from the HFTs that I mentioned. So let me just conclude. I think this is a very nice paper. I definitely recommend everyone to read it. And I think, if you really want to maximize the contribution, you could really exploit this feature of the data set. I cannot emphasize this enough, that you have the exact minute when the policy uncertainty gets resolved. Moreover, this might happen multiple times during the press conference, right? Because there might be multiple changes in one of the statements. So you can actually check even within press conference how this actually happens. And you can use this information to examine the magnitude of the news reaction, or just really define this change in expectation in a very narrow window, so you can actually capture this better. And by doing a high frequency event study, I think it would be very nice to add more intraday, more nuanced intraday details to the already established findings that we have in this FOMC literature. And, just one of the potential questions that popped in mind is that, for instance, is this documented intraday momentum that you're showing? Could this be something that's a continuation of a pre-announcement price drift that's already been established by Emanuel's paper, or is this something that kind of happens even on top? Because they look at the 24 hours prior to the announcement, if I recall correctly. So that would be it. I have some minor comments, but this is something that you will be looking at when I email you the slides. So thanks again for the opportunity.
Well, thank you very much, Zorka, for your discussion. We have a little bit more time. If people don't mind, I think, or if the presenter and the discussant don't mind, I guess it's probably at least worth a try to give the right to the audience to ask questions. I don't know, Daniela, if that comes with actively unmuting everybody, so that we have a little bit of a general discussion. If there is anything more specific that the authors want to reply to the comments, then I think we would also have time for that as we go along. But I would like to give the audience a chance to ask questions, and ruthlessly taking the first spot here as the organizer, I would like to ask, you highlighted, Roberto, you highlighted this fact that there's a change in statement compared to the previous release. So there are very standardized pieces of text in these announcements, or is that so that you can actually track it to this sentence being replaced by that sentence?
Yes, so we can actually track it, as you pointed out, because the majority of the statement remains the same. Like actually the similarity has increased over time, and okay, it's impressive. So if you don't mind, can I actually answer also Zorka's comment?
Yes, of course.
So first of all, thanks Zorka for your great comments. I would like to start answering first of all your microstructure comment. So in the paper, we basically have run also some analysis on the quiet period, which is the period in between. And so if it was just a microstructure effect, we would actually continue to see the trend during this time, during this window, but actually we don't find anything. So from 2 p.m. to 2:30, it's actually flat. And then actually this goes back to your Fed put point. Our result is actually very different from the Fed put, because what we find is that when the stock market went down at the statement, it keeps going down during the press conference. So it doesn't seem that the central banks actually wants to resurrect the stock market price, but if anything, it lets the stock market going even farther down, which is exactly the opposite, at least during this press conference. So the way we interpret is exactly, you're right. We interpret, okay, there are different agents, different investors. They have different machineries. And so by having different machinery, some of them have already correctly interpreted the statement. And for some of them instead, they are slowly interpreting the statement during the press conference. And so that's actually why we find that if the statement produced or whatever, if the stock market went down around the statement, then the stock market continues to go down around the statement, or vice versa. And that's actually why our strategy is so profitable. About your point, whether we can use like shorter windows around the statement, of course we can. We are just actually using the things that people traditionally have used, which was 150 to 220, just not to innovate on this. And then somebody would have said, okay, but you know, Nakamura and Steinson have used 150 to 220. Why are you making it different? The truth is we have quote level data, while most of these scholars have trades. And so we can definitely use, I don't know, from 159 to 21, okay, to 201, we will find the same result. And actually we have these things, but they are not in the paper, but we can definitely put them in the appendix. In terms of within analysis, we actually have done the within analysis. This is section 4. So we have used the exact moment in which the news come, and the way we have linked the press conference to the statement is through the dummy. So the dummy is always equal to 0, except in few moments in which it's equal to 1. And so the pooled OLS that we run, and that doesn't consider effectively the press conference fixed effect, is just for the Corsair analysis. But for the within analysis, we do have also the fixed effects. And so that basically should take care of your suggestion, like of your comment, let's say, in the sense that exactly because we can consider different intercepts for different press conferences, then we can effectively like correct for this increase in transparency, which happened over time. But for the pool OLS, like the coarser one, where we run like basically the scatter plot that Roberto plot, where we just run press conference news on to statement news. I agree with you, but we cannot add firms press conference fixed effect because we have only one observation per press conference unless we pull the asset. But I think over there we are actually doing the reason why we're running this. It's for standard errors. Like we're doing some improvement on standard errors by clustering, both at assets level and press conference level. So then I don't know, like I don't think I have more to say. But thank you very much. It was really great.
You're welcome.
Okay, very good. Any questions from the audience? So I see one hand raised.
Okay.
So I think thanks Tobias for your question that you wrote on this. So basically, if we talk with hedge fund managers that actually trade on this, and they receive at the second they release the statement, they release 2 columns. They receive an email with 2 columns with the words added or changed between 2 consecutive statements. And basically they have the information right away, and based on that, they try to infer if there is new guidance about the future path of monetary policy or about future economic outlook. So for them, it's quite, they use this information to trade based on this. And then we also have these new feeds like Bloomberg, like this Bloomberg news. And then we try to match, okay, when was this Bloomberg news in the terminal and when are we able to identify it? And we don't have that in the paper, but we have it for sure. And then we see that our measure leads the measure, the Bloomberg news, by a couple of minutes or seconds. So because for us, we are able to identify it when they talk about it, while for instance, Bloomberg news might take a couple of seconds to put it on Bloomberg. But that's a good point.
Exactly. So coming from Bloomberg, we also have some comments around the thing that we identify. For instance, for the mid-cycle adjustment, they were saying, oh, there is no plan for a series of rate cuts and so on. And these were actually, I mean, economists writing on Bloomberg blogs and so on. And there is the timestamp also for those. Mm-hmm. And we were able to download them.
Very good. Further questions?
So, you know, well, I really like the paper, and I wonder, also related to some work that I'm doing on a similar topic, mostly on the impact that the Fed is having on the movement at the international level. One thing that we find in our paper is that there is a sort of asymmetry on the type of impact that, you know, the Fed is having on the stock market, and also we were looking to credit default swap, sovereign credit default swap. Even in your case, you were looking to some asymmetry, and actually it seems that there is the positive effect is a little bit less significant than the negative one. You know, clearly, maybe you don't have enough, let's say, observation to distinguish, because I'm not expecting that all these type of talk will have really the same impact. And also maybe they are conditional on the situation, so on the previous volatility that you already have in the market. So I really would like to see if there is any asymmetry, and if you can, in some sense, enrich a little bit your analysis by conditioning the reaction to the level of VIX that was present in the market before, or the day before, or something like this, because the impact should be different, conditioned on the economic situation as well.
I totally agree. I think it's a great comment, and also we were thinking, in fact, to use option on VIX, like, so that we have high frequency data over there in order to reach. So thank you so much. And we were also very interested about this asymmetry, and you are totally right. It seems that actually when the statement news was negative, then in those minutes in which the chairman was saying something negative, the market was sort of really going like crazy and really like responding harsh. While we don't find the same effect as you pointed out, like the effect is way smaller for the positive days in which sort of the market has responded fine. So I agree with you. That's actually what we find. It's very interesting to develop it further.
So Emanuel, yours?
Yes, thank you. I also like the paper. I think it's a great data collection and sort of massaging exercise, which probably, I mean, it took a lot of effort, and I think this can be used for many other things. So I would encourage the authors to look into other dimensions. I have one comment and a question. The comment is, I concur with Zorka that your view of information being sticky in the sense of Rice and Mankiw may not be really what's going on here. I think these press conferences have been introduced to essentially provide context to this rather dry sort of statement that's purposefully or not written in very technical language that many even experts don't understand. There's research showing that you need, I don't know, a PhD to understand the level of sort of the FOMC statement, and you need sort of many years of training to sort of even understand the words they're using. And so I think that information is being sticky, I think, is maybe not the right interpretation. My interpretation would be that that basically it's the information is presented in the press conference by the chair in a more accessible way. So it's basically the statement, I think most of the time has exactly the same information. It's just that basically it's being presented in a more understandable, accessible way, and probably your results relating to reduction of uncertainty, etc., point in that direction. And I would encourage you to do more along these lines. So focus a bit more on sort of how much uncertainty is being reduced by these sort of by the context that the chair provides. And another dimension where I think you may want to look into is only in 2011 have these Q&As by the chair been introduced. And from 2011 to 2019, there was a press conference only after every other FOMC meeting. Only in 2020, a press conference after every FOMC meeting has been introduced. So basically you have this nice 8-year period where you can look at the information processing of financial markets to FOMC statements in a sort of interesting, differential way. There's some FOMC statements where there's no subsequent press conference, and there's others where there's a subsequent press conference. And I think there's many interesting things going on sort of across these meetings in a differential way that you may want to shed some light on with your machinery. And then finally look at speeches as well, if you can use your tool to also understand how information from speeches is incorporated into asset prices. I think that will be also very useful.
Yes, so first of all, Emanuel, thank you really very much for your comments. First of all, we actually totally agree with you. Like the way it's probably a matter of terminology and using the Mankiw and Rice in a very broad way, but we are thinking in terms of like, okay, the statement needs to provide some context, and investors have different machineries to interpret this context, which is what you were referring to, like this Wall Street Journal article of the people need a PhD to interpret like the statement. And I think this actually goes back to the real role. I mean, the fact that the statement must be clear, but doesn't have to be too clear, because otherwise it means that the chairman must commit to that policy. And so it's sort of vague and clear at the same time. And so I agree with you. Actually, the press conference was introduced only in 2011. It was actually a proposal by Janet Yellen under Bernanke as a chairman. And, you know, like they had only after the 2-day meeting, as you pointed out. And so, in fact, we actually sort of explored this a little bit. And then when we ran the regression using only the ones that do not have the press conference, we found no result for the Corsair. And in fact, in the paper, we only have one picture for trading volume, where we say, okay, if trading volume really spikes during the press conference, only like in this period, like in that time, in this window, only when there is a press conference. But when there is no press conference, you find that trading volume basically goes to almost zero. So I totally agree with you, and we can definitely develop it further, like this distinction. But thank you very much. And again, I think it's a matter of like saying sticky information. It's probably like the wrong way, but we are thinking of some people reacted faster, some people reacted slower. On aggregate, it looks like sticky information. So the problem is like on aggregate, but it's exactly because people have different machineries to interpret the information.
And with this methodology, we can see when we see these price changes that go in the same direction as they did. And then once you aggregate out, that looks like in a standard sticky model, like as in the reaction. And let me just go back to your question, Zorka, about these time effects. I think that's very interesting. And we did that, but we just didn't put it on the paper. And what we can see is that you have higher effects, even for like these effects that we are documenting, they are increasing over time. So for Bernanke, we had some effects, for Yellen increases, and now for Powell is where we have huge effects. So actually it's becoming higher and higher.
Okay, very good. I would suggest that we basically stop here because we have to introduce a few technical changes for the next group of presenters and discussants. Thank you very much so far. It was very stimulating and insightful.